What if the biggest opportunity in crypto right now isn't about price at all? Because while everyone is focused on price, a new rule is quietly deciding who gets to earn and who doesn't. And the truth is, this isn't just an update. It's a complete shift in how the system works. Welcome to Rula. Make sure to subscribe and turn on notifications so you never miss the latest crypto and XRP updates. This video is for educational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. This episode discusses public statements, reports, and market speculation for analysis purposes only. Most people think this is just another routine update, but that's exactly why it's being overlooked. Over the past few days, a quiet shift has been taking shape in the background of the crypto industry. It hasn't dominated headlines the way price movements do, and it hasn't triggered immediate reactions across the market. But beneath the surface, a new framework is beginning to form, one that directly affects how people earn inside the crypto ecosystem. At the center of it is a proposed regulatory compromise, often referred to as the Clarity Act framework. On paper, it looks technical, but in practice, it introduces a very specific idea that changes the entire dynamic. Not all rewards in crypto are treated the same anymore. This is where confusion starts, because many people hear fragments of the update and assume that earning opportunities are being removed altogether. That's not actually what's happening. The shift is more subtle, and because of that, it's far more important to understand correctly. What's being introduced is a distinction, a line between different types of earning. And once you see that line clearly, you start to realize this isn't about shutting crypto down. It's about redefining how the system is allowed to function moving forward. And that distinction is exactly where things start to get interesting. Here's where things start to separate perception from reality. Most people heard about this update and immediately assumed one thing: that earning rewards in crypto is being shut down. That idea spread fast, and on the surface, it sounds believable. But when you actually look at what's being proposed, that's not what's happening at all. The real change comes down to a single distinction: passive versus active rewards. In simple terms, passive rewards are what you get for doing nothing. You hold a stablecoin, leave it sitting in an account, and earn returns over time. No movement, no interaction, no participation. Just money sitting there, growing on its own. Active rewards are completely different. They come from doing something inside the system. That could be making transactions, providing liquidity, trading, or interacting with platforms in a meaningful way. In this case, your funds aren't idle. They're part of real activity happening across the network. And this is exactly where the line is being drawn. Under this new approach, rewards tied purely to passive holding are being restricted. But anything connected to real usage and participation is still on the table. In other words, earning isn't disappearing, it's being redirected. That's why so many people are misreading the situation. They're reacting to the idea of rewards being limited without realizing the structure behind it has simply changed. And once you understand that shift, a much bigger question starts to emerge. Why draw this line in the first place? That question leads straight to the real motive behind all of this. Because this isn't random, and it's definitely not just about crypto. At a deeper level, this shift is about protecting how the traditional financial system works. Think about what happens if millions of people start moving their money out of banks and into stablecoins that offer similar returns. From a user perspective, it makes sense. Faster access, global transfers, and in many cases, better flexibility. But from the system's perspective, that creates pressure. Banks rely heavily on deposits. Those deposits are what allow them to issue loans, support credit systems, and keep the broader economy moving. If that capital starts drifting into crypto platforms, especially into setups where money just sits and earns, it begins to mirror a parallel system. And that's where regulators step in. What's being addressed here isn't crypto itself. It's the idea of a passive, interest-like system forming outside of traditional finance. Because once stablecoins start behaving like savings accounts, the line between banking and crypto begins to blur. So instead of shutting everything down, the approach is more controlled. Passive earning, the kind that looks and feels like bank interest, gets restricted. But activity-driven earning, the kind tied to real usage, is still allowed to grow. In other words, the goal isn't to stop crypto. It's to prevent it from replacing certain parts of the financial system while still letting it evolve alongside it. And that's where things take an unexpected turn. Because this shift doesn't just limit behavior, it quietly changes how the entire market is about to operate. And this is where the entire game quietly flips. Because once that line is in place, the way you earn in crypto is no longer about just holding, it's about doing. Under this new structure, rewards don't disappear, they simply follow activity. If your funds are moving, interacting, or contributing to the system in some way, earning is still very much part of the equation. But if they're sitting idle, doing nothing, that's where the restriction comes in. So what actually counts as active? If you're using stablecoins for payments, that's activity. If you're trading on an exchange and receiving fee incentives, that's activity. If you're providing liquidity to a protocol or participating in decentralized finance, that's also activity. In each of these cases, your funds are part of something happening inside the network, not just sitting on the sidelines. And that distinction matters more than it seems, because it shifts the entire mindset from hold and earn to participate and earn. The system starts rewarding involvement instead of inactivity, movement instead of stillness. From the outside, this might look like a limitation, but in reality, it's a redesign. Platforms won't just compete on who offers the highest passive returns anymore. They'll compete on who creates the most engaging, functional ecosystems, where users are constantly interacting, transacting, and contributing. And here's the interesting part. When rewards are tied to real activity instead of passive promises, the system becomes more grounded in actual usage, less artificial, more sustainable. Which raises a much bigger implication. If earning now depends on participation, what happens when large institutions step into a system built exactly around that? And this is where the narrative starts to flip in a way most people don't expect. Because while this shift might look restrictive on the surface, it's actually solving one of the biggest problems that's been holding crypto back for years: uncertainty. For a long time, large institutions have been watching from the sidelines, not because they don't see the potential, but because the rules haven't been clear. When you're managing billions, you don't move based on hype. You move based on structure, compliance, and predictability. And until now, that clarity hasn't really existed. But with frameworks like this starting to take shape, something changes. Suddenly, there's a defined boundary, a clear understanding of what's allowed, what's not, and how systems are expected to operate. And that kind of clarity does something powerful. It lowers risk. When risk becomes measurable, institutions start paying attention differently. What once felt uncertain begins to look structured. What once felt experimental starts to look like infrastructure. And that's exactly why this moment matters. Because at the same time that passive earning is being limited, a more stable and compliant foundation is being built underneath the market, one that large players can actually interact with confidently. This also explains why areas like decentralized finance continue to stand out, because they're built around activity, liquidity, transactions, participation, which fits directly into the direction these rules are pushing toward. So while some people see restriction, others see validation. Not validation of hype, but validation of a system that's starting to align with real-world financial standards. And the moment that alignment becomes clear enough, that's when capital doesn't just trickle in, it starts to move with intention. But here's the part most people underestimate. This shift doesn't hit the market instantly. It builds quietly before anything obvious happens. But here's where timing becomes the part most people misunderstand. Because even though this framework is already being discussed, nothing changes overnight. What we're seeing right now is the beginning of a process, not the final result. Before anything fully takes effect, there are multiple steps that still need to play out. The proposal has to move through review, adjustments, and approvals. And even after that, there's an entire phase where regulators define how these rules actually get applied in real situations. And that phase is where the real shift begins. Because while the public is waiting for headlines, platforms aren't waiting at all. Behind the scenes, exchanges, protocols, and companies start adapting early. They begin adjusting reward systems, redesigning products, and restructuring how users interact with their platforms, all to stay ahead of what's coming. Most users won't even notice it happening. From the outside, things may look the same. You log in, you use an app, you see rewards. But under the surface, the mechanics are changing. Systems are being redesigned so that what feels simple on the front end is actually compliant and activity-driven in the background. And this creates a strange phase in the market. On one side, you have information spreading, partial updates, mixed interpretations, uncertainty. On the other side, you have quiet preparation, companies positioning themselves for the rules that are about to solidify. That gap between perception and reality is where confusion builds. Some people assume everything is being restricted. Others expect immediate market reactions. But in reality, this is a transition period, where structure is forming, but impact hasn't fully shown itself yet. And that's exactly why the next phase catches most people off guard. Because by the time the effects become obvious, the positioning has already happened. And this is the phase where expectations and reality start to separate. Because when people hear about major changes like this, they expect the market to react immediately. Big news, big movement. But that's rarely how it works, especially when the shift is structural, not emotional. Right now, the market is in a transition stage. On one side, there's growing awareness. Headlines, discussions, speculation, all of that is building. On the other side, there's still uncertainty. The rules aren't fully finalized, the timeline isn't complete, and most participants are still trying to interpret what it all means. And when those two things collide, you don't get a clear trend, you get hesitation. That's why price action during phases like this often feels slow or directionless. It's not because nothing is happening, it's because too much is happening without full clarity. Liquidity starts to build, positioning begins quietly, but conviction isn't fully there yet. And here's the key insight most people overlook. Markets don't move on information alone. They move when that information becomes certain. Right now, we have signals, we have direction, but we don't yet have full implementation. And until that happens, large capital tends to wait, observe, and prepare rather than act aggressively. But once that certainty arrives, the behavior shifts. Because when institutions finally understand the rules and feel confident operating within them, they don't ease in slowly, they move with scale. And when that happens, it doesn't just affect one asset or one sector. It influences the entire structure of the market. That's why this phase, even though it feels quiet, is one of the most important. Because it's where positioning happens before momentum becomes obvious. And by the time that momentum shows up clearly, the opportunity is no longer early. And this is where everything comes together. Because when you step back and look at the full picture, this isn't just about rewards, stablecoins, or one piece of regulation. It's about a shift in how the entire crypto system is evolving. The era of simply holding assets and expecting passive returns is starting to fade. Not all at once, and not everywhere, but directionally, the change is clear. The system is moving towards something more structured, where earning is tied to participation, not inactivity. And that shift changes how you think about everything. It changes how platforms are built. It changes how users interact. And most importantly, it changes how value is created inside the ecosystem. Instead of relying on passive incentives, the focus moves toward real usage, transactions, liquidity, and engagement. At the same time, this structure does something else quietly in the background. It makes the system easier to understand from a regulatory standpoint. And when something becomes easier to understand, it becomes easier to trust. That's the part that matters most, because trust is what brings in larger capital. Not hype, not short-term excitement, but clarity and structure. And that's exactly what's starting to form here. So the real takeaway isn't that earning is disappearing, it's that earning is evolving. And in markets like this, the people who adapt early to how the system is changing are usually the ones who find themselves ahead when everything else finally catches up. The content is for educational and formational purposes only and should not be considered financial, investment, or legal advice. Cryptocurrency markets involve significant risk. Always do your own research. Thank you.